All right, I'm excited today. We have Mike Silagadze of EtherFI. We're out here live well, we're not live, this is recording at ETHDenver. But Mike, thanks for joining us. If you could give us a little bit of introduction to yourself, how you ended up in this business and why, and then let's hear about EtherFi and what you guys are doing and building, and we'll take it from there.
Great. Yeah, thanks for having me. I appreciate it.
Sure.
So my background, I guess like a lot of people, I got into crypto pretty early. I bought my first Bitcoin in 2011.
Nice.
Cool.
Wow, that is early.
I read about it on Hacker News and just started goofing around with mining and just watching the space and playing around with it.
Sure.
And have been dabbling in it ever since. But in parallel to that, I actually ran another company. I started out of undergrad around that same time. Called Top Hat, which was an education technology company. I ran that and had some good success with it. We grew it up to 500 people and
Wow.
good scale. And then we actually sold the company about a year and a half ago.
Wow, congrats.
And part of the motivation to sell the company was actually just seeing what was happening in DeFi. One of the things that I didn't love about crypto. And still don't love about crypto is, the majority of it is gambling.
Sure.
Most of it is very speculative. There's, 95% is sort of this kind of hype nonsense and maybe 5% of kind of real value. But that 5% I think is going to change the world. And that's what excited me about it. In particular,
Nice.
seeing some of the early protocols, the early DeFi protocols like Compound and Balancer and Uniswap and all those guys. Made me feel like this was actually delivering on the promise of crypto and what it was supposed to be. In
Nice.
other words, value creating software that would actually let you do things that you couldn't do before. It would really open up capital and all the good stuff that we all believe in. So decided to switch gears and focus on crypto full time.
Did you have an idea of what you wanted to do focusing on
No,
crypto, or you were
we
just
actually
kind of
didn't.
like, I'm going to see what happens?
Figure it out.
I had, there was a lot of capital floating around. I had a little bit of money now to deploy.
Sure.
And so what we did was we started a hedge fund.
Okay.
Just a crypto hedge fund that raised a bunch of external capital, so some of my own capital, and ran two strategies, two funds basically under it. One was a market neutral US dollar fund.
Okay.
And the other one was an ETH staking fund.
Nice.
It was sort of like this 1-2 punch where like, hey, you get your bond-like yields on your USD, and then you get almost like an index fund that had exposure to ETH with staking plus, the yields.
Right.
And so I thought that was a good balance, of strategies. And as we started getting into staking and looked at all the options that were available out there, the DeFi protocols, centralized exchanges, we very quickly realized that there wasn't anything that we were comfortable using. Pretty much all of them required us, one form or another, to give up custody of our ETH,
Right.
which is kind of silly. Like, all right, you're getting your 5% yield, and you're effectively giving up control of your asset. That just doesn't make a lot of sense,
Yep.
especially given the risk in the system. And so we started building this thing for ourselves, and this thing eventually became EtherFi, which is the first truly non-custodial, decentralized liquid staking protocol. The way it works, one of the big differences versus anything else that's out there, I think, is that the staker is the one that actually generates the keys. In every other protocol, every other staking option, the staker deposits their ETH, and then that gets sort of shuffled along to a node operator who then stakes it and actually has the credentials.
Right.
And there's varying degrees of economic incentives that protocols use to kind of like wrestle control from the node operator, in a sense, to make the stakers, varying degrees of more safe.
Right.
But there's nothing more safe than actually just having your keys, because if you have your keys, you don't really care what happens to the protocol or the node operator. You have your keys and you can get your ETH back no matter what. If the SEC sends an angry letter to whatever protocol or node operator, you don't care. You just get your ETH back. So that's the first principles starting point of EtherFi. It's the only one that lets you do that. The second big difference is we are building it in such a way that others can actually build services on top of the staking infrastructure that's deployed on our protocol.
Nice.
And those services, anybody that touches the blockchain uses one or a dozen different services to collect data, to get APIs, to submit transactions, to do all kinds of stuff. And those services are all centralized, which is fine in a sense. The companies that run them are really good companies and they do a good job. But I think there's a value in decentralizing those services and taking that revenue, which is hundreds of millions of dollars at this stage, huge amounts of revenue, and putting it back into the ecosystem. So in our case, that service revenue goes back to stakers and node operators.
Nice.
So that I think is a fundamentally different approach to liquid staking.
Okay, so I've got a lot to ask you about. Okay, let's get back to the actual staking mechanism and the key mechanism, because I really want to understand. I want our audience to understand how this functions in the context of validators, node operators, and my ETH that I'm putting into your liquid staking protocol.
Right.
First of all, very excited at this moment because I've looked at a lot of the liquid staking options in the market, and I'm only considering the decentralized ones. And I'm even more excited because you're focusing on being able to build on top of it, because I have something I'm thinking about for that. So
cool.
So now I'm really excited, but I really want to understand how this generating my own keys and maintaining control of my ETH works in the context of node operators, validators, and staking. So if you could walk us through that, that'd be great.
Yeah. So if you're doing solo staking, just yourself,
32 ETH.
Yeah, you got your 32 ETH, or maybe you're using Rocket Pool, which is awesome. So we're huge fans of a lot of the other alternatives. I think it's worth saying that because there's a lot of people building a lot of cool stuff in staking, and I don't think there's going to be one flavor that solves everything for everybody.
Sure.
So Rocket Pool is great for lots of people. Stakewise, great for lots of people. Diva, just to give a bunch of people a shout out, is doing great stuff. So we're one of many options, and I hope it's going to be a multipolar world. Okay, so the way it works, if you're staking with yourself, the first thing you do is you use the Ethereum Foundation CLI probably to generate a mnemonic and a set of keys.
Right.
Those are like the private keys that you use to then generate your validator keys.
Okay.
And then when you do that, you then generate what's called deposit data, which is a public JSON information blob that contains the withdrawal address, so where you want the ETH to come back to when you unstake it, as well as the public information that identifies the validator that you're about to stake with. Then what you do is you submit that deposit data along with 32 ETH to the Beacon Chain deposit contract.
Okay.
Great. So that's the solo staking path. When you want to unstake, what you do is you issue what's called a voluntary exit command on the Beacon Chain. So this is a bit of a nuance on Ethereum that's actually different with Ethereum than like any other proof of stake chain, and there's historical reasons for this. But you cannot actually exit a validator to get your ETH back on the execution layer. In other words, there is no smart contract you can write. It's impossible to write a smart contract that gets your ETH back.
Okay.
Which is like scary, right?
Right.
The only way you can get it back is by executing what's called this voluntary exit command on the Beacon Chain.
Got it.
So that means that you cannot write a smart contract that both stakes and unstakes. You have to do it through basically an economic incentive mechanism.
Got it.
Okay, so that's the solo staking loop. You generate the keys, deposit your ETH, and then to exit, you run your validator. Then to exit, you do this command, and then the ETH magically, gaslessly shows up in your withdrawal address, whatever you specify.
Okay.
Okay, so in our case, most of those steps are the same. Step one, you generate your keys, you submit your deposit data and your 32 ETH into our contract. You then get paired up with a node operator.
Okay.
There's various ways. You can select a specific node operator, or you can just send it to auction. Whatever mechanism you choose a node operator. That node operator is then able to then needs the validator key in order to be able to actually run the node. Right. And there's a sort of a key exchange that happens through IPFS, where the staker is able to give just the validator key, encrypted validator key, to the node operator, and then the node operator runs the node. Now, when the staker wants to get their ETH back, they have all the keys, they have the validator key, they have all the credentials. They just issue the exit command, and their ETH magically shows up in their wallet.
So are they issuing the exit command from your site, and that's executing on?
We are actually going to give them that option to not from our site, because you don't want to upload that to a website.
Right.
But we are going to give them the option where they can do it through us. because otherwise they would need to run a beacon chain node, which is
Right.
it's a bit of a hassle.
Yeah.
Or they could just do it themselves. We don't, obviously if they prefer not to share their signed exit transaction with anyone else, that's fine. But we'll give them that service for free.
Very cool. Okay, so are you envisioning? So first of all, this is not a liquid staking offering where you're offering.
It actually is, yeah.
Fractional levels.
Yeah,
of
we are.
32.
Okay. So we talked about the use case of a person coming in with 32 ETH.
2 ETH, right.
And the whole sort of loop there.
For everybody listening, that's the required amount
Correct,
to be able
yeah.
to be an actual
That's right.
validating on the
Every validator has 32 ETH. That's
Right.
just a hard-coded number.
right.
So let's go to the next level of sort of detail. When the staker does this, we mint a withdrawal safe, which they control. And the way they control it is using 2 NFTs that are minted.
Okay. Nice.
So those NFTs represent the economic interest of the validator. They basically represent your control over the 32 ETH. The 2 NFTs are, one is a transferable NFT, which represents 30 ETH. And then the other is a bonded NFT,
Okay.
which represents 2 ETH. The bonded NFT is non-transferable. So in other words, you can't get rid of it until you exit the validator.
Got it.
What you can do with the transferable NFT is deposit it into a liquidity pool, that then mints the liquid staking derivative. And that's how you get like a fraction amount of ETH. Now, another user can come in and let's say they only have like 1 ETH or half an ETH. They come in and go directly to the liquidity pool, deposit their half an ETH or whatever, get the liquid staking derivative,
Right.
And now they've got
Nice
staking
model.
exposure.
Yeah, that's
And
nice.
if a lot of people do that, the ETH accumulates in the pool. Then the pool starts minting validators, depositing the NFT back in,
Nice.
and vice versa. If the pool runs out of ETH, then it starts exiting validators, and then the ETH kind of gets replenished.
I'm assuming that this is really a fully automatic system where the person setting up being the validator is not controlling like some level of commission or take that they could take from the commissions earned, or is that possible?
The thing they do have control over, and this is just the reality of staking, is the MEV and execution rewards. So like minor tips and stuff.
Right.
That is like I guess you could call it like an honor system.
Right.
Where they have to redirect those back to the withdrawal safe. If they don't do that, we have a monitoring service that detects cheating. We alert the staker if they choose to be alerted. That hey, someone the node operator is cheating you out of your MEV fees. You should probably exit the node and like find a new node operator. And
Okay, that's very cool. And when I come in with a partial, am I picking an operator or just adding my
No,
ETH to the
that's just
liquidity
an
pool?
auction.
Okay, cool.
If you're going to the liquidity pool, that just gets auctioned
That's awesome.
off.
That makes sense. It's too complex otherwise. Very cool. This sounds really powerful.
Yeah, it's very very exciting. I think it is a fundamentally different model, as I said, in that it starts with the staker generating the keys, not this sort of kind of reverse process. I mean, it's almost weird, to be frankly, that we have standardized as an ecosystem on this model but the default is the staker loses control of their ETH. Like,
Right.
Why is that the model?
Why was that the
Like,
model? Yeah.
and-
Well, it's probably the easiest for the centralized version.
It is easier.
Right?
Yeah,
Yeah.
it's easier.
Yeah.
And I think it was kind of like a process that was, I mean, I don't know, it's hard to speculate, but it was systems designed from the perspective of a node operator.
Sure.
It was from the perspective of like, hey, I want to run a lot of nodes. Can I get others to come and stake with me so that, we can do this liquid staking model? We started at this as a staker. We're like, hey, we have tons of ETH as part of our ETH fund. We want to stake it. What's going to make us comfortable? Well, the only way we're comfortable is if we hold the keys. Can we design a protocol that actually lets you do that? And that was the starting point. So I think that in addition to, I mean, as you can see, like our system has a lot more complexity, and that's bad in some ways, obviously, because that more things can go wrong. But
It's more
I
pure.
still think it's the right way to do it. I mean, again, I wouldn't want to stake any other way.
So maybe I just want to make sure I'm understanding every component of this. This is a very, from way that you've described it to me, it's a very top. I don't mean top down by top. I mean top down by the node, the original validator putting their 32 ETH in. there is no market for the smaller liquid staking folks unless that person does that and then deposits the NFTs into the liquidity pool, right?
There needs to be somebody that's willing to put up the bonded ETH.
Right.
So I'll say two things. So the bonded ETH actually earns a higher yield. So those two NFTs I described, there's the 30 and the 2. The 2 ETH has a role. It has the role of you're responsible for that node operator.
Right.
Anybody who has that bonded, the NFT, they have the keys.
Right.
That's their role. So their job is to monitor the node operator, because if there's a slashing event, we're working with a number of insurance partners. If there's a slashing event, that the NFT serves as the deductible for the slashing insurance to protect the transferable NFTs. So you're putting your ETH at risk, and you're also agreeing to exit if somebody asks you to exit the validator, or else you get slashed. So there's a lot of responsibility associated with holding this BNFT. So it actually earns a 50% boost on the staking rewards.
Oh, nice. Okay.
So for a sophisticated fund, like if you're, or not a fund, or anybody who's understands key management and all this stuff, this is a great way to earn yield on your ETH, because you're getting a 50% increase in yields. You don't have to run nodes. You don't have any liquidation risk. You don't have any complexity associated with it or leverage or whatever. You're just staking your ETH and getting an extra 50%.
Your biggest risk is picking the wrong node operator.
Yeah, and that's where you can choose, hey, I really like, I don't know, Kiln, who's a partner of ours. I really like Kiln or Finoa or whatever. I'm going to use those guys, and I trust that they're going to do a good job. And that's probably a good assumption. So there has to be kind of a lineup of people. If there's tons of ETH getting deposited into the liquidity pool, there has to be at least a fractional equivalent amount of people lining up to stake ETH to be sort of the bondholders.
Nice.
So it's kind of there's basically a 15-to-1 ratio that needs to exist between people who are willing to do the complex work of being a bondholder and people that are just willing to passively stake.
Yeah,
does that make sense?
No, totally makes sense. Yeah, I get it. Are you live?
So we launched what I call a marketing gimmick, which is a fully audited contract where people can sort of line up and deposit their ETH to accrue bonus points, which will be then taken into account when they move their ETH to stake in our protocol. Okay. So it's literally it's a simple contract. You put in your ETH, you're accruing bonus points. When time comes to actually stake the ETH with us, you're going to get boosted yields or something like that.
Yeah.
And maybe other things.
So you build up a pool of investors. You've got people.
Exactly. So we've been launched for 48 hours. We've got $3+ million have been deposited, which is not bad.
No, that's pretty good.
We limited it. We limited the size that people could deposit because we really don't want people, aping in and being stupid. So we have a huge number of, I think a huge number of small depositors, people putting in
that's great.
0.1 ETH, 0.5 ETH, which is great. Yeah. So so that's the first thing that's live today. The reason we launched that is because we wanted to make sure that when we announced our protocol, which we did on Tuesday this week, people would have something to do. Right. And so now they have some way to participate. The actual protocol where they'll be able to stake will be launching early April. That's our awesome. Target date. We're just in time for Shanghai.
Nice, very nice. In terms of the building on top of it, right? Yeah. What are you guys envisioning people utilizing the platform to do? Is this integrating it with other protocols, integrating with treasuries? What are your thoughts on it? Institutional integration?
So people can, and this, I'll say this is the most speculative part of what we're building, partly because there's a lot of technical implementation that we still need to figure out. And the things that we envision now that could be built on that are kind of unimaginative. They're just things that already exist. So we're you could build it on top of ours too. And so I'll give a few examples, but I'll just say they're probably not interesting examples. It's more just here's how it might work. So we hope to integrate with something with EigenLayer, which we're familiar with those guys, which is a restaking platform.
Just so the audience that might not know what EigenLayer is, it allows for the reuse of staked assets to secure other protocols or potentially other
services,
operations or services. Right.
Yeah.
Okay.
So one thing someone could build on our staking infrastructure would be a decentralized RPC endpoint network.
Oh,
So you can
nice.
kind of like say you've got these NFTs. These NFTs have metadata associated with the validator, like they have like which client it's running, what geography, what the node operator is, what service it's running, and so you can enroll these NFTs. Say, hey, this validator, I want it to be an RPC endpoint. This one is a
Nice.
part of a private MVV pool. This one's running some API, and then those nodes then run that service. The billing for it is run through our smart contracts, and the revenue is shared between stakers and node operators.
Love that.
So the simplest thing, probably the simplest thing you could build is an RPC endpoint, a decentralized RPC network offering. It's probably a bad idea because RPC endpoint networks are actually like performance is really important and it's kind of complicated to like do it right. So maybe the benefit of doing it this way is it'll be way cheaper. You can almost do it for free in a sense.
And it's decentralized.
And it's decentralized, yeah. So you don't have any risk of
decentralized RPCs.
Exactly, yeah.
Right.
I mean, Lava Labs is doing some cool stuff with that. So that again, it's like the most boring thing you could do, but hey, it's probably something you could cook up in like a weekend.
Yeah.
But I think people come up with other interesting things.
That's very cool. I love building an ecosystem on things. I've always felt like one of the best ways to grow and build what you're building is to have developers building things and let them bring in people. That's great.
Yeah.
That's
That's the only way I think to ultimately create any kind of differentiation or a moat.
Yeah.
Is like staking is great, but it's it's kind of a fundamentally undifferentiated business that's where the margins are going to get compressed. So we're thinking, okay, how do we build something that is actually valuable and can scale over time? And I think you have to almost commoditize the staking yourself.
Yeah.
And focus on like what else can people build on it, the services and other stuff to add value.
Yeah, I was head of product for a company that was in the internet fax space years ago, and it was kind of this battle to the bottom for price and trying to do the most you could to recruit big companies to do it, mortgage companies, et cetera. And I said, look, one of the things we can do to expand this business and make a lot more money from it is just build out a developer network around this thing that nobody gives a damn about anymore.
Right.
And that works really well, right? Because now you had people that were already embedded in banks and already embedded in mortgage companies who were like, oh, I can customize the workflow. I can customize this. And that, I think that's a really smart strategy. That's fantastic.
Right. Yeah.
On a side note, what most banks never realized that they were doing was they were booking an internet fax business, but they weren't actually sending faxes. They were, because so much of it became internet fax amongst all the companies, it became this transferring of files across the network, but they were paying per page rates for faxing.
So, wow. That's clever.
It was clever. And still going on to this day. I mean, it's a really profitable business. Anyway, all right, so that's very cool. All right, so then the other piece I want to ask about is, you kind of threw out there that you're talking about products around this that are coming from you that are more data oriented, that kind of thing. Can you walk us through, I mean, what you're going to build or have built or what we're going to be able to do that you guys are going to be offering from that perspective?
So do you mean I guess we probably will build some of the services as a demonstration, but we actually hope to have others build stuff.
Oh, so this is the building on, so when you said 1 and 2, so when you said 1 and 2, the first one you talked about was the core service, and you talked about hoping people will build on it. I misunderstood and thought the part 2 was you guys were actually going to be building data services, et cetera, on top of it as well. I get it now.
Yeah.
Okay.
So
but it's more other people doing it. I get it.
Exactly.
Okay.
Like what we hope to do, and this is months out after we launch and we get some usage, is start hosting series of hackathons just to see what people build.
Nice.
And then raise a fund around it.
Cool.
Raise sort of an ecosystem fund to invest in companies that are doing really interesting.
I love that. That's a great
work.
idea.
And I think people are probably going to come up with much more interesting things than what we can.
How's the protocol make money?
So we, like other staking protocols, we take a share of the staking revenue, 5% of the staking revenue. And then in addition, there's protocol revenue that also gets split between stakers, node operators, and the protocol. Protocol revenue includes the auction revenue that I mentioned, where node operators participate in an auction. And it includes also the liquid staking derivative, because with us, instead of having to go to a curve pool to trade for the liquid staking token, you would just get it 1-for-1 on our pool, both minting it and burning it.
Right.
And we would take a small fee on that.
Nice. No, I like those. That makes sense. Makes sense.
Yeah.
Are you still running the funds?
We're still running the ETH fund in particular because
Yeah,
that's
makes sense. It's a motivator.
it becomes a regulated vehicle for people to invest in into the protocol.
That's awesome.
So that if you have somebody who's an investor, they're interested in deploying it to DeFi or liquid staking, but they don't want to deal with hardware wallet and
Figure it out kind of
apps.
stuff.
They can just go directly through our
smart.
ETH fund. That's also how we're going to be, let's say, routing American and Canadian investors.
Nice.
Because we don't want to ruffle any feathers. We're going to only limit this to international customers.
Cool.
Canadians and Americans will have to go through the ETH fund in order to participate.
So they'd have to be accredited in order to
Correct.
participate?
Yeah, that's right. Unfortunately, it's only accredited investors.
Yeah, that's sad. That's depressing. Well, that makes sense. Very cool, man. Is there anything else we should know about it? Where do people get involved? Are you guys hiring? What's
we
going
sure
on?
are. Yeah, we're hiring. If you go to ether.fi, we got a sweet domain name.
That's a sweet domain.
Yeah.
That's awesome.
Ether.fi, go to there. You can apply for jobs. You can read our white paper. You can participate in our marketing gimmick.
Nice.
You can eventually stake through us. All the great stuff is there.
That's exciting, man. I really love what you're doing. I'm really excited about this. Sounds great. I love the ethos. I love your approach. Fantastic. Congratulations.
Yeah, thank you. I appreciate it.
Thanks, man.
Yeah, awesome, Mike. Thanks.
Appreciate it.